Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and it was only 2 weeks ago that Adam Taggart and Chris Martenson of Peak Prosperity were here on this show to talk about their new book titled Prosperity. The subtitle to this new book, which you can easily find in any major bookstore or online, the subtitle to that book is How to Prepare for the Future and Create a World Worth Inheriting. Because I think this book is so important, and because we didn't get a chance to focus on various aspects of the book, but one in particular that I want to talk about. I'm really happy to have both Adam and Chris back with me again today to cover some of this material that I think is so important. So thanks, Chris, and thanks, Adam, for joining me again.
Oh, my pleasure.
Always good to have both of you with me so soon again. When you two joined me, you both explained about financial capital. You talked a little bit about financial capital, but you talked about there's so many other forms of capital that are really important for us to develop because financial capital might not be all you need. We sort of had in mind that if we just build up a huge bank account, everything will be okay. Adam, maybe you could help us understand why maybe millions of dollars in the bank may not be all we need.
Sure. And, let me say first and foremost, it's not going to hurt. But what we find that most people who have a lot of financial capital but not a lot of the other types of capital that we talked about on the previous show, they tend to be very defined by that money. And as we talk a lot about in the financial capital chapter of the book, Prosper, we talk about a lot of the threats to the purchasing power of that wealth. And I'm sure we'll get into that a bit in this discussion here. But those that have a lot of money and only a lot of money, they basically live with a chronic anxiety because they either know consciously or subconsciously that their financial capital is under threat. And because their entire identity is wrapped up in it, they're basically just staring at a future where it seems inevitable that financial capital, its purchasing power, its value is eroding. And they don't know at what pace it's going to erode, and they live in fear of, which we think is not an unwarranted fear, of another 2008 style crash or worse that could vaporize a lot of that wealth very quickly. And the emotional insecurities that we see from these people is, my gosh, if my money truly defines me, and I let it define my happiness in life, if it suddenly goes away from me, whether it's very quickly or just sort of a grind down over time, what's left of me? Who am I? So it's surprisingly, there's a phrase out there that says some people are so poor, all they have is money. And we like to use that as a starting off point when we discuss this topic.
Yeah, that's sort of humorous in a way because I've always thought that if you could just build up enough money, enough capital, enough financial capital, you'll be well off. But I guess, Chris, anything to add on that? I mean, it seems to me what we're talking about, loss of purchasing power, is certainly something that we understand. But I think you're talking about other possibilities as well, infrastructure breakdown and so forth, which is always possible. Indeed, we live here in New York City, and we experienced the Hurricane Sandy, which did a great deal of damage to a lot of people and disrupted their lives significantly for protracted period of time. But anything you'd like to add to what Adam just said?
Well, sure, Jay. What Adam and I are really talking about is once people actually understand how the system works, so maybe the just-in-time food delivery system or the actual state of our grid, if you look into the electrical grid of the United States and the various threats that might make it go away for a period of time, and you look at all the things that we've built up for ourselves in our society, you quickly discover that we have a very cost-efficient, very complex system of life built for ourselves. Of course, those things could get disrupted, and Hurricane Sandy certainly created a regional disruption. We're concerned that it's no longer unthinkable that we might have a more widespread disruption, say, within the banking system. If we had a big financial accident, say the derivatives pile really caught on fire and burned down for the banking system, or there's another geopolitical conflict that causes capital controls to be imposed across borders, or there's a big banking holiday, or anything like that. So really, what Adam and I are trying to raise awareness around is this idea of being actually truly diversified. So most people that hear diversified, they're thinking what their broker just told them, and it means I'm in U.S. equities and foreign equities. And we believe that true diversification is you take a portion of your financial wealth, some portion, maybe it's 5%, maybe it's 25%, depends on your circumstances, but you dedicate that to becoming actually more robustly diversified into other areas of your life, which are these other forms of capital that, should there be a disruption, these things will prove immensely valuable in that future scenario. But if you do it the way that we've gone about doing it and that we outline in our book, Prosper, you can do this in a way that actually brings you measurable, quantifiable, and quality of life improvements today, no matter what future arrives or doesn't arrive. Mm-hmm. And so we think it's just a really dominant strategy is to get yourself robust, resilient today in ways that really improve your life today. And if this future does happen, if these various scenarios happen, you'll be really glad you did these things.
Right. Chris, well, you talk about taking a portion of your financial capital and setting it aside into a resilience-building fund. We talked about resilience the last time that the two of you were with us. How might this be done? Give us an idea of what we might do. Take 10 or 15% or 20% of our financial capital and put it into different buckets you talk about. Could you just talk about that a little bit?
Well, sure. So briefly, some of the other buckets we talk about are things like material capital, which could be, in my case, as I look out my window, my material capital is solar hot water, solar thermal, extra insulation in my house, and a variety of things that give me multiple ways of both heating my house and cooling my house, and also needing to do less of both of those things because I've invested in insulating. And so we have a number of examples, particularly at our website as well, where you can look at, hey, if I was going to take some money and I wanted to earn a nice 18% on it, where would I put that? Well, Wall Street can't guarantee you anything at this point. You can't put it in bonds. But if you put it in insulating your house and also air sealing it, there's a measurable, quantifiable ROI right there. So that's on this idea of material capital. We've got a bunch of investments people can make which have identifiable returns to you. Now, these are typically for homeowners. If you're a renter or you're in a big apartment complex, maybe less applicable. But for people who are in a position of being a homeowner, there's fantastic returns to be had there. And so note what happens. First, you're investing, you're getting good return today. 2, you're probably living in a more well-insulated, comfier home. And 3, if there's a future energy shock, you'll be less impacted than somebody who hasn't taken these steps.
Right. Another concept on page 61 of your book, you must be prepared to lose money. We don't like to think in those terms, that's for sure. And when I turn on my MSNBC or CNBC or any of the major networks, they're certainly not telling you that you should ever think about losing money. Adam, could you explain why you're so certain that we should really plan on losing money?
Sure. So, as we say in the same chapter, we list out a lot of the both risks to the current financial system, and that has to do with a lot of the stimulus that the central banks have pumped into the markets that's reinflated asset bubbles. So we feel that there are many asset prices that are overvalued very much in the same way that many were back in 2007 before the credit crisis brought prices down. So first off, we just want to make sure that people are looking at the landscape with an informed, eyes wide open perspective about the risks that are out there. Mm-hmm. Those risks from our perspective are, lower prices are likely coming. We also talk in the book sort of at a macro level that we feel kind of in the grand game from a macroeconomic standpoint, the natural forces of deflation are trying to win out here and likely will in the near to midterm. So we see ourselves as entering a pretty punishing deflationary system that then will be met by the central banks with a very highly inflationary response. It'll sort of make the money printing that we've seen so far seem like, probably like just the early innings of the game. So we want to make sure that people kind of realize that we're most likely in a macro sense going to go down in terms of prices before they start going back up through inflation. And getting back to the other forms of capital, a really important one is emotional capital, which is the ability to deal with adversity with confidence and without becoming immobilized or paralyzed by fear or making bad decisions or rash decisions under pressure. And during deflationary periods, particularly if they're compressed, again, sort of like 2008, where prices are falling very quickly, most investors find themselves flat-footed, and they either stay in investments that they should not be in, they don't take on the additional cost of insurance to protect against the downside, or they make really rash decisions and end up regretting them later on because they weren't thinking them through. So for all the risks that we list in that chapter you mentioned, we tell people at the beginning, look, expect that you're going to lose money, that everybody's going to lose money, and emotionally prepare for that first. What we then say, though, is, yes, you should plan to lose money. The trick is to make sure you lose less than everybody else on a relative basis. And that's where we go through some of the solutions, particularly on the hedging side. There are lots of strategies that you can use today. We recommend you do them with an experienced professional financial advisor. A lot of people aren't terribly familiar with placing hedges and using defensive options themselves individually, and they can be a little bit complicated. So definitely do it under the guidance of a trained professional. But there's lots of steps that you can take today to make sure that when the deflationary forces that we feel win out and prices really begin dropping, you've already got an action plan in place. And so you're simply mobilizing your plan, and you're able to feel confident and not emotionally torn up about it, where we think the average person who hasn't planned is really going to be experiencing and suffering some mental anguish then.
Yeah, deer in the headlights is a picture that I can see, and I've experienced myself in 2008, 2009, I must confess. We Adam, you talked about the sort of macro picture that's going on, but I could see then that probably hitting people in higher taxes, probably pension funds. I mean, all of these things that we sort of think of as safe and secure, maybe all of a sudden aren't so safe and secure. So would like to ask you, Chris, where do you think we are in this process? Adam was talking about deflation. We've seen huge amounts of decreases in the price of metals and the energy products and so forth, oil and gas and copper and gold and iron ore, and all these things have had massive declines in their valuations, yet we've seen stock prices, of course, flirting with new highs all the time. Where do you think we're at in this process of deflation, Chris?
Jay, I think we're just getting started. You mentioned many of the sort of deflationary things we're looking at. Deflation for us, of course, is a monetary phenomenon. Either credit and money are expanding or they're contracting. We think that China was an obvious big major driver of the expansion, tacking on over $20 trillion of new credit in their system in just an 8-year period, an astonishing number. And the whole overall world has taken on probably around $60 trillion in new debt since the crisis at this point. And we don't have a lot to show for it. And this is how you get a deflationary wave is you invest a lot of money by borrowing it into things that they can't pay back. So that's what we're seeing. All the commodities, the key ones, iron ore, I believe, is now down 80% from its highs in 2011. It's just astonishing. Coal, oil, cement, oil's back at 38 as we're recording this right now. Astonishing. So those, to us, suggest that the stock market is whistling past the graveyard. We've seen a gross destruction of the internals of the stock market. It's really looking very unhealthy. And, of course, everybody's kind of hoping, requiring that the central banks will somehow magically keep it all elevated. We think that's a mistake. We think that's a sucker's bet. We think that first we're going to experience a big round of deflation. It's going to be painful. It's going to be scary. There's going to be a lot of wealth destruction. It's going to be centered in the credit markets. We see an extraordinary disconnect now between triple C debt and stock prices. Normally, when you have a big spike in yields in triple C junk debt, you would see the stock market going down. It's a very high correlation, but it's been missing in action for the past month and a half or so. We think that's also, one of those two markets is wrong, and we usually put our money with bonds to be correct. So we're expecting that deflation to come. It's going to be really a fairly unpleasant moment for the markets. And then we think there's another round of this, which is the central banks really hitting the panic button and getting money to Main Street, which is why we think people need to have a plan. They need to understand what they would want to buy, what assets they would want to own for the future, because when the Federal Reserve, for instance, gives you or I a check, or we get tax rebates, or however they put money in the hands of Main Street, that would be your moment to run, not walk, to buy these things that you already know are assets you would like to own.
Right. Well, we've certainly seen the quantitative easing has put money in the hands of Wall Street. We haven't seen it get out to Main Street. So what you're saying is at some point in time when we have a when this market really crashes or when it goes down significantly or when prices in general continue to decline, there will be a panic, and then the politicians, the policymakers will put money one way or another, helicopter money, I guess is the vision that's given, either through tax rebates or just simply giving us checks. Then if the money was in the hand of the masses, are you suggesting then we might see a turn from this deflationary environment to an inflationary environment, even a hyperinflationary environment, Chris?
Yes, that's exactly the call that we'd be making because, if we back up a bunch and look at this from a very high-level view, money is just a claim on stuff. I want to buy a guitar, I need money. So if there was more money than guitars, obviously guitars go up in price. And debt is a claim on future money. Look, we have $200 trillion outstanding debt. We've got, however many trillions of dollars in currency out of the market. We've got the world's major leading central banks having a quarter of the world's GDP on their balance sheets at this point. And we think that's just a big, dry pile of tinder. All that has to happen is for the people with money to decide they'd rather not hold it. They'd rather be holding something tangible. And we think that's what the next leg of this story is. So where today everybody's talking about how smart they are for being in the stock market, pick a number, a couple of years out, people will be talking about how smart they were because they bought land, gold, things like that, tangible pieces. So we fully expect this to end one way or the other, Jay. What has to happen is we have too many claims against too few things. Mm-hmm. Either that goes down a deflationary route and we just wipe all that stuff off the books and nobody wants that because political careers get ruined and bankers get pilloried and institutions fail. Or we go down an inflationary route, which ultimately takes it away. There's only one third option on the table that they're talking about. I hope they don't do it, which is locking us all in this banking prison, as it were, and then forcing negative nominal interest rates down our throats, forcing us to lose money on money that we've saved. That is a third plan. They're talking about it, but I really hope we don't go there.
I'd like to switch gears a little bit and talk, Chris and Adam. Maybe, Chris, have you opine on this to start with, but I've seen reports of huge amounts of gold flowing to China from the West, and then I'm reading that Russia is selling their oil to China in exchange for gold, and indeed, according to these reports that I've read, Russia has been importing a huge amount of gold in exchange for their oil. And it seems to me, this is quite out in the open, that the BRICS are preparing to compete with the NATO countries, with the dollar system. They've made no bones about it. They're not trying to hide it. Do you think that all of these wars and things that are going on now, we're seeing Russia increasingly involved in the Middle East and the oil fields. Chris, do you think that that this is something people should be aware of as a possible catalyst for some major changes going on in these financial markets and these commodity markets?
Absolutely, Jay. This is a set of topics that we've been covering in detail at Peak Prosperity. I've written reports on what's actually happening in Syria, the fact that the United States appears to say one thing about ISIS, but then is doing another. So we say we're bombing them, but somehow we're actually supporting them and actually protecting their oil smuggling network. It's all crazy time. And, of course, Russia is being sort of marginalized, and we're attempting to put a power play on Russia. You have to understand that really, the larger context of this is that Russia, China, and the West are all trying to figure out who maintains dominance over the Middle East oil fields, which is the last best stuff on the planet. Everybody knows that. Don't let's not kid ourselves. And, we have a very, very large, I think it's got like 12,000 words. It's a big report on gold, specifically talking about this flow from west to east and noting that there's at least 1,000 ton, but maybe a 1,500 ton per year deficit going from the west, heading into China, India, and Russia collectively. And so the only question is, where does that gold come from? Well, we know it's coming out of Western vaults. Gold, you can't print it out of thin air, and they're not buying paper in those places I just mentioned. They want the real stuff. So we're convinced that that this price manipulation scheme of keeping gold down has been successful. It's helped do some policy aims that the central bankers want, but it's cost them, and it's costing them an increasing amount of gold leaving the West. That can't continue forever. It can continue until you physically run out, but politically, well before then, we know that the West would not part with more than a certain amount of gold. And so that's that's the trend. And of course, I do think that China and I think Russia are both engineering a way to get themselves away from the dollar as fast as they possibly can. Of course, it's a slow process, but that's what they're doing. And it will not surprise me at some point in the future to discover that gold gets essentially remonetized or backed by one or more countries outside of the dollar standard.
Yeah, if we're sealing off essentially through, well, we're trying to force, in a way, it seems as though we're almost trying to force China and Russia together with the sanctions and so forth that we've placed on those countries, and in any event, it seems to be maybe working against our best interest in the longer run. But in any event, I should mention, so you have a large, a very extensive report on gold. People can buy that, read that at Peak Prosperity, Chris?
Yeah, that will be coming out. It has a free front part, which has got a lot of content in it. And then for people who want to go deeper, we do have a subscription newsletter service, and that's where we put all the meatier, deeper analysis and usually a little more descriptive. What should I do? How would I play this? How would I position myself? What would I do about this?
Sure. It's peakprosperity.com, folks. Just take that down, go there and read, avail yourself to all the wonderful information that's there, and think about subscribing to the letter and the book, of course. Well, anyway, let's talk in the remaining minutes we have here about what we can do to protect ourselves against this impending inflation, assuming that that's the direction we go. Well, first of all, what should we do now before we hit that inflection point and we start seeing prices rise again? What should we be doing right now? Adam, maybe you'd care to add some things there.
Sure. So the tricky part about this game is making sure that while we have a fair amount of confidence from where we're starting and where we're ending, we don't exactly know the path that we're going to follow to get there.
Mm-hmm.
So you got to make sure that you're not putting all your eggs in one basket at one time, and then have the market surprise you, and then lose a good chunk of what you're trying to protect.
Mm-hmm.
So we do recommend a diversification strategy. Chris mentioned an important part earlier, where start by looking at your financial wealth and asking yourself what percentage of that you want to put into that resilience building fund we talked about. So start there. Secondly, we do think that we are, over the sweep of history, wealth used to be defined really by tangible assets.
Mm-hmm.
We've moved into a very financialized period of history, and we believe that the pendulum is now swinging back into harder assets, and one of the main reasons for that is because they can't be inflated away in terms of their intrinsic value. So in general, we recommend that people start looking at, all right, how do I get my money out, or a greater percentage of my money out of financial paper claims and into real tangible ownership of hard assets. So that's, Chris mentioned a few of these, but that's things like land, it's things like owning commodities directly. We would put productive businesses in that same category. There's a whole list of items, and we certainly go into this in the book.
Mm-hmm.
Secondly, too, it is not a bad time, even, and this might sound a little counterintuitive, but it's not a bad time to build cash.
Mm-hmm.
Because we do think that we're going to be going through this deflationary period first. And, believe it or not, with all the flaws that we've just listed and the risks to the U.S. dollar, in the near term, it is going to be the most likely one of the preferred, if not the preferred initially, safe haven when there's a flight to safety. So, playing it safe, taking your chips off the table and just storing them in cash, that's not a bad thing to do with a percentage of your money here. And I just want to underscore something I said earlier, but this is a diversified strategy. It will require a little bit of sophistication, and we think that most people who have real lives, who are busy, who don't manage capital, on a regular basis, who don't have the time or the seasoned experience to watch the markets frequently, building this whole strategy and plan under the watchful eye of a experienced financial advisor who is appreciative of the risks that we've been talking about in this interview. We recommend, if you can do that, you really should. And Chris and I, even as much as we follow the markets, we still work with a financial partner, because it's always good to have an extra pair of eyes and an extra brain in the room to make sure that you're being smart in terms of how you're putting your strategy together. But also, again, we're all busy people. We all have real lives. We can't be watching the markets day in and day out every day. And we're going to be entering an increasingly volatile period where things may happen and begin to happen quite quickly in the market, and relatively quick decisions are going to need to be made. And having a partner that's actually doing that full time is a great early warning detection system.
Yeah, well, it all makes a lot of sense, and certainly building your cash at a time when you expect prices to continue to decline also makes a lot of sense. Owning the dollar makes a lot of sense, and I can understand it certainly seems to be the direction of things for now. And I just tell my listeners there are so many topics we don't have time, of course, to go into, but the idea is for you to buy the book, Prosperity. It's a very, very important book. But just some of the ideas, as Adam was just talking about, building cash, build an emergency stash, keep a reserve for hard times, build up your dry powder so you have money to buy things at the bottom of the market when things are bottoming out sometime. That's how you can actually come out ahead in these difficult times, potentially financially. Diversify your other holdings in different currencies and so forth too. But of course, precious metals makes the most sense because that's a time-honored monetary unit that cannot be created out of thin air, and so it makes all the sense in the world to own gold and silver for sure. Prioritize cash flow, develop multiple streams of income, amass passive income. Those are all topics that are covered in this wonderful book. So I really want people to go and buy this book. You can buy it any bookstore, online, anywhere, and go to peakprosperity.com. One more thing before we let the both of you go. Chris, towards the end of Chapter 6, there's a caption, live below your means and invest the difference. Talk to us a little bit about that, the importance of doing that.
Well, yeah, this is that's time-honored advice, goes way back. You can get a nice Dickens quote around that or further. So the idea here is to really take a good, hard look at the budget. It's one of the things that we talk about in this chapter is to get a good sense of your financial inflows, outflows. You make sure you understand your balance sheet, your cash flow statement. And then most people, we've discovered, if you really look, you can find ways to trim unnecessary expenditures. And if you can get those below your actual needed cost of living, then you can invest the rest. For many people, it's an eye-opening experience. They discover that once you factor in credit cards and this and that, they're really not even living hand-to-mouth. They're actually slowly going further into debt over time. And so we think this is a great time to, as you mentioned before, this is a good time to be as defensive as possible, to really build up some dry powder for the times that are coming. We think it would be a mistake to think this moment in time will continue as is forever. So this is a really important idea for us, is to, live below your means for a while, save up money and invest the rest.
Yeah, and certainly, I might add just my own opinion there. If living below your means doesn't mean that you're less happy. In fact, you might actually spend more time doing things in life that bring happiness, sharing with others and giving to others that might actually be of greater importance. I think both you, Chris and Adam, would agree with that.
Oh, absolutely. Let me say that the statement we use is, I've cut my standard of living in half, Jay, and I've doubled my quality of life.
Yeah, I can believe
I
that.
have a much higher quality of life now than before when I had a boat and a bigger house and all sorts of things.
Yeah, all of the difficulties that go with maintaining that and running around like crazy trying to take care of everything, and you don't have time to give your wife a hug or some things that are important like that, perhaps. So anyway, we are out of time. It always goes so fast with both of you. Thank you, Adam, and thank you, Chris, for being with us. Once again, you guys have some really important things to tell people, and so I'm so pleased that you could be with us again. So thank you very much.
Our pleasure. Thank you.